Very excited to be putting on another one of these. For those of you who haven't attended one before, we've been doing this for a few years now, and we cover various topics that are very important for our clients' financial well-being, but may be more tangential to what we do on a day-to-day basis. So we bring in professionals in that area and experts in that area to be able to do these presentations and give some education for our clients. So this particular one, as others have been, will be recorded. It will be available to anyone that registered, and will also be on our website. In a couple of days, you'll get an email saying that it's available. And if you are interested, you can go to the Client Center on our website, and you'll see this presentation, and you can see some other ones we've done. Some very popular ones we've had were Estate Planning 101, and we brought in a local estate planner partner at a firm. That was more, not quite as sophisticated as what we'll be doing today, but just a good 101 for people. We've also brought in a funeral home director for end-of-life planning, and we've brought in one I thought was particularly interesting with everything going on in the world today, a multi-generational firm for property and casualty insurance, and just the things that people should be thinking about. So those, as well as this and these slide decks, will all be available on our website. If you can think of anyone when we're done with this that may find value, we have family or friends or coworkers that you think of while we're going through this, it would mean a lot to us, and we'd really appreciate it if you could send this along to them as well, and get this knowledge out to the people that need it. And I also want to just thank Gerry and Kasha for joining us tonight. Tonight's our main presentation will be on planning gaps and opportunities for high net worth. That's what that HNW will be as we go through this, individuals and business owners. And so, when we were putting this together, we were thinking about who is the experts that we can go to. And, fortunately for us, we do have many companies we work with, like Rochdale, that can assist high net worth managers, individuals and business owners. But we've just found, in particular, I've really liked Rochdale's approach with things. We've been working with them for a very long time for client investments. Some of the people on the webinar I know already are using Rochdale. But on the estate planning side, we've been having more of these conversations with clients, and I've just really liked the approach that Rochdale's taken with that. So we've asked them to join us today to be able to talk to even more of our clients and those people that they know that would benefit from that. So I will kick it off first to you, Kashif. Kashif, for those in the webinar, is a managing director and a senior investment consultant at Rochdale, and has been one of our main contacts there for many years.
Perfect. Well, thank you so much, James, and thank you all for taking the time. So let me just kind of give everyone on the call a little background on Rochdale as an organization. So think of Rochdale as an investment counseling firm. So a little distinction. We're not a mutual fund company. We're not a brokerage firm. We have no model generic portfolios. What we do specialize in is working with the independent financial advisor, such as James, and through them, we custom create investment solutions for their high net worth investors. So at Rochdale, we have $1 million minimum. Clients that we work with, whether they have 1 mil, 5 mil, 20 mil, or more, we always want to find out from the clients and from the advisor what the goals are for that portfolio, what the objectives are, what the tax considerations are, what the risk considerations are. So we have a much more dynamic, customized, personalized implementation approach. And we use individual stocks and individual bonds as much as possible, because that enables us to be, with James in this scenario as the advisor, enables us to be as risk control oriented and as tax efficient focused to make sure we're looking to build the portfolio so it's in line with the financial plan that James and team put together for you. So we do that investment philosophy for all clients. But as James mentioned, over the past couple of years, we've had a growing demand and growing clients come to us and say they want some planning discussions, planning strategies, whether it's charitable planning, legacy planning, philanthropic planning. So we have built a team with Gerry. That's our advanced planning team at City National Rochdale. Again, everything that we have that we're going to go through today is able to all of you on the call through your relationship, through your interaction with James as your advisor. So getting on that planning discussion. So Gerry is one of our managing directors. He's a senior wealth strategist. He's been with the firm for, I want to say 5 years, almost 5 years, but in the industry, doing estate planning, financial planning, business succession planning for well more than 25 years. And he's got a very strong background. He's worked at firms like First Republic Bank, Allstate Financial, New York Life. So he brings a lot of resources to you to really help you navigate through that planning discussion and charitable planning and what factors would be relevant to consider and think about. So with that being said, let me hand it over to you, Gerry.
Thank you, Kashif, and thank you, James. Interesting topic of the day, planning gaps and opportunities. James, I know the invitation that went out had an emphasis on philanthropy. So by all means, we will be emphasizing philanthropy. The planning, financial planning for wealthy Americans is a little bit different than for rank and file mass affluent clients. In that the emphasis is not so much on, will I have enough money to retire? The emphasis is more on things like philanthropy, asset protection from lawsuits, capital gains tax mitigation strategies for those that are looking to sell a capital asset that has a low cost basis, and estate and legacy planning, as James had mentioned earlier as well. Those are the primary issues for high net worth folks. And the true or false that I would kind of raise this as to get your thought process going. The wealthier you are, the more buttoned up you seem to be in terms of all aspects of your financial well-being. And I'm laughing, of course, and you probably are laughing with me because you know the answer to that. Question is, no, the more wealth you have, the more moving parts, the more strategies that become available to you. So in almost all instances, when we meet with wealthy clients and business owners and from all walks of life, we're able to identify where what we have in place is not optimal to meet the objectives in those 4 areas. And one more time, it's asset protection, income tax, estate planning, and philanthropy. Those are the 4 primary areas. So we start with goals and objectives, right? And then we put side by side, here's what you're solving for, here's what your objective is in those 4 areas. And then we look at what you currently have in place, like what planning strategies have you already implemented? And we're able to identify some potential gaps. Well, the positive spin on that is not just gaps, but these are opportunities for enhancement. So at that point, we educate you in conjunction with James and all the resources that he has at his disposal to educate you on multiple strategies. And then what we do on our end at City National Rochdale, in fact, James does some of this himself as well, is model the solutions. So we don't just talk about them, we actually model and show you your numbers and how these strategies might help you better optimize meeting your objectives. And ultimately, implementation. James is not a lawyer or a CPA. I am, but I cannot practice law. Even though I am an attorney, my role is not to replace your lawyer, but to work with her or him, as the case may be. Ditto for CPAs and accounting professionals. We're here to help you, educate you on these strategies. And what's really nice is my clock is not ticking. There's no like hourly fee. I'm attached to Kashif on the portfolio management side, but my services are a complementary resource. So these are what we call the 5 pillars of wealth. I already mentioned asset protection, income tax, philanthropy, estate, and legacy. Investment planning is the culmination of all of those things. So Kashif and the team of portfolio managers, they kind of stay on the sidelines until we complete the analysis, a comprehensive analysis on your objectives and what you currently have in place to meet them in these four slices. Then we align the solutions with the investment planning team, and you'll learn more about that as we proceed in this deck. So we're going to start with income tax mitigation. We talk about current and future tax rates. I'll give you the short version, but as you know, 2018, the Tax Cuts and Jobs Act was enacted under President Trump in his first term of office. That reduced income taxation. The brackets at all levels was reduced. What was a 39.6% tax for the top bracket is now 37%. As most of you know, that aspect of the law is due to sunset on January 1st, 2026. So we're just several months away from the sunset. And then we go back up to the 39.6% top bracket. Now, will Congress and the Senate be able to pass new legislation to delay that sunset? We don't know, but we do know the Republican majority makes that more likely than not likely to happen. But this is not going to be a all in, the sun does not set. There's going to be a lot of horse trading on things like the state and local tax. That's going to be hotly debated. There'll be horse trading on different aspects of that income taxation. Estate planning and estate taxation may also be negotiated. So we're not sure where all this is going to land. And we'll help you in this presentation to how to navigate through what do I do in the meantime. So we're going to talk about those things. So this indicates where the top income tax brackets have been. And if you look at the beginning of this slide, all the way left, 1955, the top income tax was 90%. Now, there were a lot of deductions. I don't know if you remember the days when you could invest $1 and get $5 of deduction, but those days are long over. But that's when income taxes were in that like 70 to 90% range. But as you can see all the way to the right, under modern times, like I'm going to start with Reaganomics in the late 80s. That's where the income tax hovered in approximately 40% range, right? So right now we're 37%. If the sun does set as it's scheduled to, it'll go up to 39.6. The lower line reflects the top capital gains tax brackets historically since 1955. And you could see that topped out at 40% in the mid 70s. So right now, the 23.8, that's a pretty reasonable number. Folks that live in New York, New Jersey, Massachusetts, California, Hawaii, these are the highest tax states in the country. Add another 13% on top of the 23.8, and you're already at 37.1. So it's much more painful in these high income tax states. So we do have capital gains tax mitigation strategies to share with you as well. So where you live in terms of bracket, right? The 37% bracket, if you're married, that starts at $751,000. Okay. The bracket below that is not that much lower. 751, it tops out, but 501 is where it starts. 32%, again, it's just 3% lower, right? But the big arbitrage is between 24% and 32%. That's a big difference between those two numbers, right? So the extent to which a client has under $394,000 in income, let's say you have an adult daughter whose income is $300,000, right? Well, she's in the 24% bracket, right? Well, if you could deflect some of your income to her, now you might be in the 37% bracket plus state and local, right? She's in the 24% bracket. If you could deflect some, no, how do you do that? How do you deflect income to your daughter? Well, there's strategies where you can do that. You can set up a family limited partnership to hold portfolio assets, and gift your daughter a percentage of that portfolio. You would still control it. It's a family partnership. You don't have to distribute money to her unless you want to. But by simply setting up that vehicle, you're able to deflect some income into her bracket. Here's another idea. Let's say she has a traditional IRA, the same daughter making 300,000 a year. And let's assume, so if she's only making 300, she's got another 94,000 of income before she's going to be hit with the 32% bracket, right? You with me? So what do we do? What if James runs the numbers and says, well, if you roll over 94,000 from your traditional IRA to a Roth, you'll have to pay the income tax. But at what bracket, James? 24, right? 24%. Now, your daughter might not be able to afford the 24% tax on $94,000. That's about $22,000. Good opportunity for you to make a gift to your daughter. Pay the tax for her, right? You just moved some wealth, but it accomplished lowering the income taxation profile on your daughter. So that's just a couple of quick hits. We've got a lot more strategies like that. There's the use of incomplete gift trusts, where you're able to also deflect income taxation to the lower generation. Okay, so the main things you want to look at for income tax mitigation is where can you get more deductions? I told you we talk a lot about charitable planning on this call. So, of course, charitable deductions, outright gifts to charity, fully deductible up to 60% of your adjusted gross income. Then, of course, there's donor advised funds, plenty of strategies to create deductions on the charitable side of things. 199A, those of you that are business owners and you're an S Corp or an LLC or a partnership, you get that 20% deduction if you qualify, right? Charitable remainder trust now and life insurance are ways of getting income tax deferral, right? So charitable remainder trust allows you to move wealth that are low, to move assets before you sell them, right? So if you own Apple stock and the cost basis is just 10% of what the value is now, and James and Akash have come to the conclusion that you're too heavy in Apple stock, how do we liquidate without paying an income tax? And the charitable remainder trust is a great way to look at doing that, right? There's other strategies, but we're not going to be exhaustive this afternoon, this evening, but that's just some examples of strategies. Tax deferral, life insurance. I don't want to get too in the weeds on this, but James is an expert on how to stuff a lot of money into a small life insurance policy, right? There's a limit to how much you could do, but this is a means that wealthier folks are learning how to utilize the life insurance. We call it wrapper. And it's the opposite of what you would think. Most people think, I want to put small premiums for big death benefit. This is the opposite. Here, you're looking to squeeze as much money into the policy. Why? Because life insurance is one of the only ways you can grow wealth on a tax-free basis. It's tax-free because you could receive your basis out before you're hit with any gains. Okay, so more on that. We could dedicate a future call on that topic alone. Mm-hmm. Deflect, I already talked about deflecting income to the lower generation, so we don't need to go over that again. And diversification of your income sources. Think about it this way. You hear portfolio management specialists talk about diversifying between stocks, bonds, and cash, right? There's also real estate. So that's diversification. But there's a new kind of a emphasis, if you will, in the financial planning community on diversifying your income sources. Some of your income should be taxable, your salary, money that you withdraw from a retirement plan, fully taxable, right? Other income should be tax deferred, annuities. Qualified plan is growing tax deferred, right? Annuities I already talked about. Then there's tax-free, municipal bonds, Roth IRA. So diversifying your income sources is a way to mitigate the risk of income taxes. We don't know if income taxes are going to be higher or lower in the future. So having a diversified source of income is an important thing to be mindful of as well. Oh, philanthropy, charitable giving options and implications. There's multiple strategies for philanthropy. We're going to talk about them. What's the difference between an outright gift and your other alternatives, like an outright gift of cash versus gifting a low basis stock? And instead of going outright to the charity, maybe you use an intermediary strategy like a donor advised fund, and then as an alternative to outright gifts. So we're going to talk about that. And what's the most efficient way and the most efficient asset to give to charity at death? That's where we talk about efficient testamentary gifts. Okay, so we'll talk about those things on the next slide. So different options. So let's look at direct gifts to charity versus a direct gift to a private foundation versus a direct gift to a donor advised fund. So we're going to talk about a little bit of a comparison of those three things. If you know the charity, maybe it's your place of worship. Maybe it's you lost an important family member, a loving family member to a certain type of cancer. But maybe it's research. If you have a heartfelt need or desire or objective to focus on that charity and you've identified a charitable organization, then there's no reason not to do anything other than direct gifts of cash, right? I shouldn't have said no reason. The reasons where you might give something other than cash would be where you have a low basis stock position, for instance. By gifting that stock position, you could get a full deduction. You just may not be able to use that deduction all in 1 year because you're limited to 30% of AGI, but you can carry forward. Okay. We're going to talk about that in a little bit more length in a moment. When would a donor advised fund be called for, right? So the extent to which you sell your company, you sell a piece of real estate, you have a big gain, right? So your adjusted gross income in a given year happens to be much higher than your normal, right? When you have that happen, you might decide, boy, I'd love to make a gift to my church or to American Heart Foundation. I don't necessarily want to make the gift all in 1 year, but oh my goodness, I would love to have a deduction all in 1 year. So let's say you intend to gift $30,000 a year for the next 10 years to your place of worship. I'm just making up a number. That's $30,000 a year for 10 years. That's $300,000. Well, if you know that that's what you want to do, and this year you sold an asset and you've got this really high adjusted gross income, go ahead and gift the full $300,000 now to a donor advised fund in the same year as the year. Let's say you sold your company last month. Well, you could right now or wait until November, whatever. As long as it's in the same year of that event, you're able to deduct the entire $300,000, even though you're only giving $30,000 now to the charity. For the next 10 years, James is going to invest that money, hopefully with us, invest that money, that $300,000. It's going to grow in value. It's not yours anymore, but the extent to which it grows, you might get another year or two. Instead of 10 years, that might be 12 or 13 years worth of gifting to your place of worship. Okay, not to get too more in the weeds. Private foundation, families ask us all the time, Gerry, at what point in time does it make sense for us to set up our own family foundation? Maybe I could get my kids to want to participate and they get to be paid a salary, et cetera. You've got to be well over $1 million. Some would say over $5 million. The reporting requirements, the cost of setup and maintenance, and quite frankly, you need a family member that's truly engaged and rolling up their sleeves and really wanting to dedicate a certain portion of their life, of their sweat equity, if you will. This is something that requires hands-on. And if there is a family member like that, and the numbers are well beyond $1 million, it's definitely worthy of discussion because you could drive, for instance, if you have a scholarship program and you want to be involved in the selection, you can't discriminate and pick your friends and family members, right? But the extent to which you really want to be hands-on, you can be hands-on in a private foundation. Charitable Remainder Trust and Charitable Lead Trust. Let's go to the next slide. You can see an example. So let's use that low cost basis Apple stock example. And again, it could be that you're selling a rental house that you own. So it could be real estate, investment real estate. It could also be you're getting ready to sell your company, whether it's an S, a C, an LLC, low basis assets. You're getting ready to sell it, and you know there's going to be a big capital gains tax. So let's use a hypothetical. $10 million is what you're selling, a business, right? We don't generally see anybody gifting the whole business. We don't put $10 million worth of stock in a charitable trust. Now, you can do that if you wanted to, and I've seen it happen, but it's very rare in my view, in my experience. So maybe you carve out $1 million, maybe two, maybe three, okay? That's pretty typical. Let's say you take $3 million and gift it of stock or of Apple to this charitable remainder trust, right? Now you sell the whole, you liquidate the entire 10 million, okay? Well, the 3 million that's in the charitable trust, there's not going to be any capital gains tax at that moment in time. The entire 3 million proceeds comes into the charitable remainder trust and pays you income for the rest of your life. Now, it could be your life and your spouse. It could be your life and your child. Maybe. I say maybe because if you're in your 60s or older, parent and child could work in that general area. We'd have to run the numbers for you. If the child is too young or you're too young, there might not be enough left for charity in order to qualify for a charitable trust. Most typically, we see a very old parent with an adult child, or husband and wife is the most common. Now, that's 2 lives of income. And then when the second person of those 2 dies, only what's left goes to charity. So you've had 2 lifetimes of that $3 million is going to pay no capital gains tax except for on distributions as the money is distributed to those 2 people. So it could be your life first and then your adult daughter or son, or it could be your spouse. When that second person dies, that's when there's no further benefit to you or your family. Now, we could design that trust so that 90% of the pie is actually going to you and your second life. Right? Your spouse or your child. That is what we call a maximum charitable trust. Maximum to family, minimum to charity. Those of you that actually have a much higher philanthropic intent as part of your objectives, we would lower the income level. Instead of giving you 12 or 14% per year coming out of that trust, we'll dial that down and get you a greater level of deferral. For more years, you'll be able to defer the tax. Okay, enough on the CRT. I'm running a little overtime, perhaps. Let's go move on. And by the way, James, let me ask you this. Is there a place for them to ask questions in writing, or do we want to just have Q&A at the end?
Oh, no, I appreciate you mentioning that. Yes, there is a chat feature. So if anyone wants to add it in there, if it's something that can be answered while you're going, we can absolutely do that. But there will also be a Q&A at the end.
Awesome. Awesome. Okay, so think about this one. So let's assume a family has philanthropic intention. They want to leave a bequest for a specific charity, okay? And they put in their will, as part of what their will says, it says, in addition to the bequests above to my family, I want to leave $100,000 to XYZ charity. Okay, or maybe it's my place of worship. Okay, $100,000. Now, this is a quiz question. I just want to get you thinking, and then I'm going to give you the answer. Okay, if I put that in my will, I leave $100,000 to my church. Okay, is that a good strategy Or is there something better that I could have done? Think about that. Gerry, what could be wrong with an outright gift of cash when I die going to charity? Here's the answer. Okay. By saying I make a gift of $100,000 to the charity, what's going to happen is your executor is going to go into your bank account or your portfolio account and pull out $100,000 and give it to the charity. Okay. Now, think about this. That $100,000 was worth $100,000 to your kids, right? What if instead you carved out $100,000 bequest in your IRA in one of your retirement plan assets? That $100,000 is only worth maybe 65 or 70 to your kids, right? Because they got to pull it out of the IRA. Well, guess what? $100,000 of IRA money, that's worth $100,000 to the charity, but it's only worth $70,000 to your kids. So not a bad idea giving a charity $100,000. Of course, that's a beautiful thing, but give them the right asset. Okay, so this was specifically requested by James. So this is a chart showing a difference between direct gifts to charity, direct outright during your lifetime. You could see if it's cash, you get to deduct 60% of your income in the year of the gift. Non-cash, it's 50%. Appreciated securities, it's 30%. If you cannot utilize all of that deduction in the year of the gift, you get the next 5 years carry forward. Okay, so you will usually, in most instances, be able to carry it forward and actually utilize all of that. Okay, testamentary gifts, unlimited in terms of non-qualified and qualified, unlimited estate tax deduction as well. So those of you that have an estate tax, I've got a lot of families that, 14 million is the amount that's protected. So if you've got a $16 million taxable estate and you leave 2 million to charity, you've just zeroed out the tax. And in fact, that 2 million, the IRS chipped in with you on that, right? Because the tax that you otherwise would have had to pay didn't have to be paid. Qualified charitable deduction, if you're over 70 and a half, you can go direct from your IRA to the charity. Donor advised funds, we already talked about. Private foundations, note that when you gift non-cash assets to a charitable foundation, you're limited to 20% of AGI. Again, you get the carry forward, but that's one of the disadvantages of the private foundation. We already talked about charitable remainder trusts. The short version on charitable lead trusts, this is a great strategy for business owners that are looking to transfer their business to family members in the future. It's a way that if you think your business is going to grow and you're willing to pay out some income to charity over the next several years, the charity just gets some income for a limited number of years. At the end of that period of time, you could transfer ownership to your kids at a significant discount because A, they had to wait for it. So there's a time value of money discount. And B, if your company is growing at 20% a year, the value of the gift is only going to assume about a 4 or a 5% growth per year. Okay, so that's just an arbitrage. It's something that we do for certain business owners. And finally, charitable gift annuities. That's a great way to gift to charity without as much pain as an outright gift. You're going to get an income stream. It's just like buying an annuity from an insurance company, but your payout's going to be slightly lower, and you're going to get a deduction, a charitable deduction, because of the fact that your payout is lower than a fair market annuity stream. Okay, estate taxation. We're going to spend some time now on the current law and what are some advanced strategies that might be contemplated. So some of the basic blocking and tackling. So 14 million is the gift and estate tax lifetime exemption under current law. That's 14 million per spouse. So if you're married, 28 million is tax-free. So if you're under 28 million, you would think, well, then you could ignore the rest of what I'm about to say. But that's not true. Here's why. The exemption of 14 is going to be cut in half. Definitely, unless Congress changes the current law. The existing law, the Trump Tax Cuts and Jobs Act, will sunset unless the law changes. So unless new legislation happens on January 1st, when you wake up, that 14 million tax-free amount, it's now 7 million. Now, it's almost a 50-50. Talking to my colleagues and peers in this industry, there's no best guess. I don't know what the Las Vegas odds are, but I'm calling it 50-50 because they might detach the estate from the income tax negotiations, right? If they detach it, there's a decent chance that it is going to come down from 14 to 7. I don't know that for sure, but the bottom line is if you're single and if you're unmarried and your net worth is over 7 million, then you should be looking at this slide and contemplating some of these strategies because you could be hit. So annual gifting, you can gift up to $19,000 per year to anybody you want to. Usually you're looking at your kids, right? You got 3 kids, 19,000 times 3, $56,000, whatever that number is removed from your estate. You don't even have to file anything on your gift or estate or income tax return. You're on a trust basis. You can gift up to 19,000 per year. If you're married, that's 38,000 per year per person. Okay. This is a little bit too nuanced, the rest of this slide, so I'm going to go to the next slide.
Gerry, one other thing I'll add too,
Please.
and I think it will show in the next slides, but as you're referencing the federal estate taxes, each state also has their own, or the great state of New Hampshire does not, but around us, we see one, I believe Maine, Massachusetts is as low as 2 million, I believe, right now. So there's other, depending on what state you're in as well, will make these even more powerful.
Yeah, no, that's a great point. Annual gifts are great to combat states that have high estate taxes, like Massachusetts and other states that do in fact have a separate, New York, New Jersey as well. So I mean, here's a quick example. If you did gift at 38,000 a year, 3 kids, 20 years, 2.2, you actually almost $1 million of additional money goes to your heirs. And that doesn't even include, we didn't even invest that money. That assumes zero growth in those gifts. So let's go to the next slide.
Actually, I'm going to jump in one more time.
Yeah. Anytime, go.
2 other strategies, and I know this one is a little less powerful than some of the major charitable donations we talked about, but I've also seen this used for if people have kids or grandchildren. Gifting to 529s also counts as gifting out of your estate, but it still allows you control of the assets, allows you to invest, and has a tax deferral or removes tax. So, I'm not saying put 2.2 million into 529s, but it is a good place to put money in. And then we've had clients that they've done that for years. Kids go to college, and now they're out, and they start gifting, and it goes directly into a Roth IRA for the next generation. So again, you're taking money and you're putting into a tax-free bucket that's going to grow for all those years as well. So those are some of the things we've seen done with the exclusion.
Great. So 13.99, I used the number 14 to round it up, but 14 million is the current exemption. And as you can see on this slide, that 14 will come down to 7 unless Congress actually changes the law, right? But here's the takeaway I try to give clients. Whatever your political lean is, whether you're left or right, know this for sure. It's going to move back and forth. I know we're hearing a lot of stuff. I watch both Fox and CNN. I just want to hear both sides. But my point is this: if you listen to too much of television, it feels like, oh my God, it's going to stay the way it's at for a long time. No, the political winds blow, as you know. So if you're a wealthy individual, you can't count on estate taxation being at the low level that it is right now. In other words, the exemption is super high relative to historic numbers, okay? 14 million, it's the highest it's ever been, except for the 1 year when the estate tax was abolished. I think that was 2011 under the senior Bush. So the issue is it's going to ebb and flow, and you should be mindful of that. as you plan your legacy for your kids and try to mitigate estate taxation to the best as you can. So for those folks that are fortunate enough to be already north of the 14 million, right? Maybe you're even north, you're married and you're north of double that, which is 28 million. Remember, husband and wife each got 14 right now, so 28. Well, what if you're a family and your net worth is 60 million or more? Well, maybe you should lock in the 14 million by gifting it like now, because if a husband made a gift to an irrevocable trust out of the estate and wife did the same thing, once it's gifted, it will not be clawed back. Congress has spoken. The law says if you make this gift now and then the exemption comes down because of left-right politics, right? If that happens, too late. You make the gift, you're protected. It's grandfathered, okay? So those folks that have the good fortune of being very high in their net worth, folks they're doing are locking in those exemptions. It's not for everyone, but one of the things that my team has a reputation for, CNR has a reputation for, our modeling is beyond the capabilities of most all of our competitors, because it's just one of those things. It's very labor intensive what we do. Most firms don't want to go through that hassle and that labor investment. We've made that a competitive advantage to strengthen our capabilities in modeling. Think about it this way. If you're going to give away 14 million to two trusts, 28 million, right? Even if you're worth 60 million, that's half of your net worth. What happens when each spouse dies? The surviving spouse loses access to one of those trusts, right? So the issue is, can we afford to make that big of a gift? We call that stress testing. And we do that probably better than anybody out there. So forgive me with the bragging, but we're really proud of that capability. The bottom line on this slide, if you lock in the exemption means make the gift now. Look at the bottom, you see with two exemptions. Just by simply making those gifts, you immediately enhance the net to your kids by $6 million, $5.6 million. And again, that doesn't even include growth projections. That's straight off. You make that gift, you locked in that bonus exemption. The sun sets down to 7 million. You have literally saved your kids $6 million and growing as time goes on. Okay, so irrevocable trust planning. I don't want to get too in the weeds on this. Again, there's strategies where you can deflect income taxes. Again, I talked about that earlier. You're in a higher bracket, generally speaking, than your kids. You could even do this for grandkids if they're adults, right? And they're in lower tax brackets. There's some opportunities there in conjunction with trust planning. Also, estate tax planning, also collaborate. So all of these trusts, what they have in common is creditor protection. So the extent to which you set up an irrevocable trust, whether it's a charitable trust giving you income or whether it's one of these irrevocable trusts for estate planning, any wealth that's transferred into those trusts, amazing level of protection from lawsuits. If you get into a car accident, unless you do something silly like have your car owned by the trust, your lawyers are not going to let you do that, right? But if you get into a car accident, any wealth or portfolio or liquidity that you have held in any of these trusts, that car accident, somebody dies in an accident and that family sues you, they cannot get to those assets. So that's an ancillary benefit of any and all of the trust planning we talked about today. Valuation discounts. We talked about gifting the 14 million. If you own a company, every dollar of gift is only worth 70 cents. That's ballpark, right? So if you got a $10 million company, you could gift it to your trust at a $7 million gift value. Why? Valuation discounts. If you think of the Build Back Better Act back in the day that never went anywhere, the Democrats, Joe Biden, Build Back Better was going to mitigate our ability to get these discounts. Again, I'm not taking any type of political affiliation. I'm just suggesting that that was a proposal by one party to eliminate our ability to discount gifts. Well, right now, that ability still exists. And hence, it's probably not a bad idea to lock in the exemption and lock in under the today's rules, which allow discounts. Asset protection, there's two really important concepts. One is while you're alive, and the other is how your heirs will inherit your wealth. Okay. So while you're alive, how do we protect your liquidity? It's all based on asset titling. If you own it in your name, not good. You name it in joint name with your spouse, still not good. Have it titled in your revocable trust, still not good. Very available to creditors. Yeah, and I'm going to give you some more details on what is good on the next slide. But first, let's talk about generational planning, how your heirs inherit their wealth. There are a bunch of people on this call. This is hypothetical. I'm not asking you to send me your wills and trusts, but I would bet you that if I received from each of you your wills and your trusts, I would bet you that more than half of you, significantly more than half of you, when your kids inherit their wealth, it will not be protected from their divorcing spouses. And this is based on, if you guys are like most Americans, I review documents. It's part of what I do. My whole staff, we review hundreds and hundreds of documents every year. And most documents, not all, but more than 50%, they leave the wealth to the kids with outright distributions when they reach certain ages. It might be 30, 35, and 40. It might be 35, 40, and 50. Whatever those numbers are, when they reach those ages, that's when that money becomes available to potential divorce. Okay, it's not that simple. There's a lot more to it. It really depends on the extent to which that money is used to enhance the financial well-being of the family. Then it becomes a marital asset. I don't care if you're a community property state, which you're not, most of you in the Northeast, or a non-community property state. You do not want to have mandatory distributions, massive monies leaving the trust that you leave for your kid. Eliminate mandatory distributions. So here's your left to right, worst to best ownership. I said own name, joint names, not great. But once you get into corporate ownership, you've got a significantly higher amount of creditor protection from lawsuits. So what we do is we look at balance sheets. James and myself, we'll look at your balance sheet. We'll look at how those assets are titled, and we'll give you a report card as to how well or not well you're protected from potential lawsuits. The first place that you look beyond look at your umbrella policy. If there is a lawsuit, does your umbrella policy cover it? The next thing I want you to look at, and you should all do this, here's a homework assignment. Get your actual umbrella policy and read the exclusions clauses. You will be amazed at how broad the definition of things that you are not covered for. Okay, so asset protection is something that we take very seriously, more so than most financial advisors in this country. James is also a big proponent of asset protection for his clients. And then I think we're going to end it here.
Yeah.
With now that we've talked about planning with capital gains tax, estate planning, asset protection, and philanthropy. Once we've buttoned you up in those areas, that's when Kashif and the portfolio management team step in, because every bucket of wealth has a unique characterization. You might have a cash management account that's going to be needed to pay your income taxes in April. You might have in-estate assets that are taxed a certain way. Each portfolio has to be invested with a realization that the objectives are different, the tax profile, and all these other elements have to be factored in. I'll leave it there. James, you want to have some closing comments, and maybe we could stay on a little extra 5 minutes if possible and answer some questions.
Absolutely, yes. And I can stay on for a little bit as well. And so, yeah, a few of the things, exactly what you were just saying too. A lot of these you can build them really, there's general rules, but you can get pretty specific on how it's going to fit for your family. And some of them, you can set it up so you're paid income. And then we can work with Rochdale and say, for these years, we want as little income as possible. And now we need more income. And so you can make those kinds of tweaks inside of some of these different types of trust or charitable donations. Some other things that we've seen with clients, with charitable annuities, for instance, have been one I've seen more and more where they may have a family member. And I know we've talked a lot about heirs, but I've actually seen this more with siblings, right? So we had a few clients who they are wealthy in their own right, right? That from their career, maybe with stock options, business they sold, whatever that wealth generator was, but their siblings may not have been in the same position. And so I've seen them actually, they need they want a donation to charity. They have some concerns about what their siblings may do with that money, or maybe it's nieces and nephews. And so they buy a charitable annuity with that sibling or niece and nephew, or even just a friend as the annuitant. And so that person knows, hey, I've thought about you. I want to make sure you had money for, a period of time or for the rest of your life. But you also know that maybe it would hurt someone more than benefit them by giving them, $250,000, but you could donate to charity 250,000 and get annuity that would pay out to that individual, and the charity ultimately gets the rest. So we've seen things like that. We also have some younger clients, and being relative for everyone, what younger means, but younger clients who have a drive to give to charity, but as you had insinuated earlier, Gerry, we may not be comfortable with them giving it away because if there's a stress test, there is a big drop in the market that might affect their continued quality of life. But there are things like on here we have the CRUT, and there's many other options where, okay, you've locked in your charitable donation, you want to give to charity. We're going to get the deduction in these high years, but you get income still. So you're still benefiting from your wealth and able to live the life you want. And there's even some of these options where you can blend them. You can have these charitable trusts, annuities, and have your donor advised fund the ultimate beneficiary. And then your heirs or the foundation that holds the fund make the ultimate gifts. So there's a lot of flexibility we see around these. Ultimately, the timing tends to be driven around large taxable events, whether it be deferred compensation, business sales, sale of real estate, to try to get the deductions up front. But then whether you want to fund long-term charitable donations, Gerry used the example of 30,000 a year to your place of worship. Well, I have the money today, and I'm going to buy some sort of charitable remainder, and the charity gets the remainder at the end. And there's different options available to our clients. So as you've gone through, and whether that be how do we benefit our heirs and our charity of choice and not benefit the IRS? And that's what this is kind of all about. How do we maximize the amount? You referenced earlier things as simple as making the charity the beneficiary of an IRA may give 30% more to the charity and 30% more to your family. And so that's why these things are very important. I know there's so much that we covered. You went through it quickly, and I really appreciate it. And it's still here at the end of the hour. But this was really meant to be a way to show people there are great ways to give to charity. There's great ways to give to your family. And they're just, even if those aren't necessarily your main goals, you may even just have exposure you're not aware of in the way you hold your assets. And so these are ways just to start this conversation. Everyone's unique, right? And so we definitely want to encourage anyone watching, please reach out to us, and we're working with Rochdale to figure out what works for your family. Right? What is the best benefit for you, your spouse, if you have children, you have other family members or charities you want to assist. There's a lot out there. It can be complicated, but we can bring clarity to that.
James, I'm really impressed that you got the number of people that started, everyone's still on the line. So thank you for your patience. You guys roughed it out for the whole hour.
Gerry, Kashyap, do either of you have anything else that you do want to go over? I don't want to cut you off if you're on a good roll here.
No, I think we've covered everything from a planning perspective. Just to bring it all together, as Gerry mentioned, so all the planning aspects that James, you and Gerry put together, once it comes down to the implementation stage on how to invest the portfolios or how to invest the CRUT or how to invest the donor advised fund, that's where Rochdale comes in, and the portfolio management team is then going to be working equally closely with you and the clients to implement and build the portfolios. So we really want to provide, in partnership with you, James, a complete, comprehensive wealth planning solution, which I think your clients do get the sense that they're getting from you already.
Wonderful. Well,
Thanks everyone for your time.
yes, thank you everyone for joining us. And thank you again, Kashif and Gerry, for joining us later in this day. And yeah, thank you for your partnership.
That's
And
good.
thank you everyone who attended.
Great. Thank you, everyone.
All right. Bye.